This video is going to look at the balance sheet. So to date we've looked at the cash flow statement, so cash in versus cash out and the ending cash balance. The income statement, which is your sales minus cost of goods sold, showing gross profit of a business, less all the other expenses, showing the net profit of a business. So now we'll focus on the balance sheet. So the balance sheet represents an organisation's asset and liabilities. The important thing is that it is at a particular point in time. It is like a snapshot of a business at any point in time. Generally, it's at the end of the financial year, so 30 June for the relevant year, but it can be constructed for any at any point of time. And it's effectively showing the net worth of the financial position of the business at that point in time. And why is it called a balance sheet? Well, because it's really balancing the business's assets against how they have been financed, either through debt or equity. So all those assets on the left-hand side versus, well, how are they funded on the right-hand side. Like the income statement that has numerous names, the balance sheet is also sometimes referred to as a statement of financial position, not performance, but position. Okay, I'm just going to roll through these pretty quickly because these are all things that we're quite familiar with. But the balance sheet distinguishes between current and non-current assets, so things that are going to be converted within 12 months for current and more than 12 months for non-current, converted to cash. By that I mean, we have three main current assets: stock, cash, accounts receivable. Non-current assets are those things that are going to be converted to cash in a period longer than 12 months. And they're normally things like property, plant, equipment, motor vehicles, machinery. It might include some share investments or property investments. And sometimes you might see an item that's a goodwill, so the reputation of the business. And that has a financial element to it because it does have value. If someone came and bought that business, they would be paying for that reputation. Current liabilities are liabilities or obligations that must be made within 12 months. And they generally relate to a bank overdraft or your creditors or your accounts payable, one and the same thing. So they need to be paid within 12 months. Non-current liabilities, those obligations the business has that they are obligated to pay for a period longer than 12 months, and they include things such as taking out a mortgage, so that loan must be repaid over a long period of time. A bank loan, a term loan, debentures, they're all examples of non-current liabilities. You've also got on the balance sheet the owner's equity, and that's showing, well, you can look at owner's equity a few different ways, but it effectively shows what the business is worth to the owners in the context of retained profits and capital, the amount of money the owner has put into the business. So it's really showing, the overall balance sheet is showing what does the business own, assets, and what does it owe, liabilities and owner's equity. Okay, so what's an example of a balance sheet? Using our same business again for I Wish Toys, here is a good example of a balance sheet. So on the left-hand side, we've got all our assets broken down to current and non-current. We've got our three main current assets: cash, stock, accounts receivable. Stock, otherwise known as inventory. And this business has $118,000 worth of those three current assets. So it is expecting that those three current assets will be converted to cash within 12 months. So that means by the 30th of June 2016 in this example. They also have some non-current assets. So assets, things of value, which they expect will be converted to cash in the future, but in it for a period greater than 12 months. So furniture, motor vehicle, computers, building, all things that are certainly of worth to the business. They have value. They do expect them to be converted to cash in the future, but not in the short term. So their total assets, when you add the current and the non-current assets for this business, equate to $905,000. So if they had to sell everything of value in the business, that's really what they would hope to get for them as at today. Now clearly those valuations would change over time because of things such as the value of that building that's a non-current asset. If we go over to the other side of the balance sheet, so those things that it owes, it has liabilities. So in the short term, it has $37,000 of accounts payable. So it needs to pay those creditors within the next 12 months to a total of $37,000. They have a short-term overdraft or an overdraft. So their current liabilities they owe equate to $44,000. they would need to be paid within 12 months. They also have a couple of non-current liabilities, so long-term obligations that need to be paid in the long term, and they come to $502,800. So in total, they got $546,800 worth of liabilities, and that is added to their equity. So the capital, that is an owner's contribution to the business. The owner has put in $90,000 worth of capital into the business, and that owner is owed that money. And their net profit, or retained earnings, is $268,200. And that's again an example of money that is effectively owed to the business. So, as you can see there, when you add your current assets and your non-current assets, they equal all your liabilities and your owner's equity. So the accounting equation, assets equals liabilities plus owner's equity. And in this case, this balance sheet balances, and this business effectively has enough current and non-current assets on the left-hand side to meet its obligations, or those people it owes, on the right-hand side. So therefore, this business is balanced, and it is in a sound financial position. And that is the objective of the balance sheet, to demonstrate and show, is this business in a sound financial position, or in fact does it have some problems in terms of not having enough assets to cover the liabilities and the owner's equity.